Good morning, ladies and gentlemen, and welcome to today's session. As you can see, today is already the third session in our series of planning the audit. My name is Johanna Skreder, and I will be facilitating the start of today's session. We will go through, let's call it theory, practical considerations. All of us are in the same group, and then later on we will join breakout groups for both Audit International and the Probe Audit methodology. So welcome to today's session. Today we are going to address the overall risk assessment. Session 1, we looked at pre-engagement and client acceptance. Session 2, we considered the overall understanding of the client. We looked at a few of those considerations. And so now, having already got an understanding of the client, we are continuing our risk assessment procedures, further obtaining or enhancing our understanding, and therefore then getting to an overall risk assessment. Some of you may remember already, when you go to the success community for Caseware, so I literally just Google success Caseware Africa, but again, because I've been on this so often, then I actually land on the success community. And then in the knowledge base, I just search for Get Ahead. There are other ways also to find it, but I found this is the easiest way. Then I don't need to remember what to do, where to go. I just go and search and I click Get Ahead 2025. Then I get to this page, or as they like to call it, an article. So what I'll then see in this is, first of all, the almost like the index. In the index, you can see there are learner resources, so that's the material for the different courses, and then also recordings, the schedule, the frequently asked questions, etc. So if I go to learner resources, there, according to each of the courses, we've got the Audit International for level 1 and for level 1, the material there. Level 2, which is what we are dealing with today, the planning of the audit. If you use the Audit International methodology, that's where you'll go and you'll just simply click on there and it will download a folder with all the little subfolders, which is the Caseware file that you'll use in the course, as well as a little subfolder for every session with the slides that we are using. The same goes for Probe Audit Premium, where you'll again have your Caseware file as well as the slides. Once or twice we had a little example on an exercise, they are also included in there. And then if you happen to need the ones for the financial statements, like for example, yesterday there was a webinar, if you need to download that, that's also there. If we then go back up to the agenda and we click on the schedule with the recordings, this is now very, very nicely and streamlined. You don't need to wonder which recording goes where. You can simply say, oh, I didn't watch the introduction to Caseware, let me watch the recording. Or this is session 3 of level 2. I remember that I missed session 2 of level 2, which was held on the 21st of February. Let me go and watch those recordings. Oh, see, there's 3 recordings. What must I watch? There's a combined session, there's the Audit International breakaway, there's the Probe Audit breakaway. Which one do I need to watch? And I can do those. All right, so that's really quite simple and easy. If for some reason you prefer to do it on YouTube, I've also just gone to the YouTube page. So if you are on YouTube, you go for the Caseware Africa and Adapt IT division, that channel. And then, well, for me, it's not already coming up because I've obviously watched those videos a few times to check that they've been loaded up correctly. But then under videos, you will see that there's a variety of those uploaded there. And every time we indicate whether it's audit, of course, level 1 or level 2, and then which session it is. The sessions also have little examples or descriptions rather. The descriptions also explain to you exactly what you need or what you want to watch and what's included. If there is perhaps a session to watch before the time as part of the combined session, or if you need to go to a breakaway session after watching a combined session. So you can just really follow that through in terms of catching up on the requirements. All right, so I believe that will then address where we want to actually watch recordings of previous sessions as well as the material. What is it that I'm going to need for today's session? So also just to stick with that, if you have not yet downloaded the material for the series, the Audit Level 2 series, we're going to use the same file as the previous 2 sessions. So if you have already downloaded that file, it's exactly the same file. I did not make any changes to that file for today. So you can just go back to that Caseware engagement file or otherwise download the new one, and you will then be able to see exactly what I'm showing you in the engagement file. All right, so that's enough then of our links and where to get the information. And then let's have a look at our agenda. So we're going to start off as we do every time to say, where are we in this process? So we are planning an audit. So we are in the planning process, but where are we in this planning process? And then what's to come? And of course, what have we already done? We will then be spending quite a bit of time of understanding the entity and understanding the entity's internal control. Now you'll see there 3 or 5. It happens to also be the 3rd of 5 sessions for our series, but that specific 3 or 5 just gives you an indication or reminds you, if you look at the slides later on, there are 5 elements to internal control, and in today's session we will only deal with 3 of those 5, but more on that when we get to the relevant topic. Then laws and regulations, how do I consider that and treat that in my audit? The fraud risk assessment, the resources consideration, communication within the team, all of that theory and things that I need to consider, some examples. We're going to work through all of that. And then, of course, at the end, we will end off with our probe or AI breakaway sessions. Right, so that's what we're going to work through today. Good. Starting with, where are we? Before I continue, I'm going to just switch off my camera because that takes a lot of bandwidth, and I know that you would rather see my slides and hear my voice than necessarily see me. So because I'm not all that important, or seeing me is not all that important, let's switch that off, and then we know that you can rather get the information that you really need, and of course get the instruction and the background. Right, so what have we done to now? So to date, we have done in session 1 of the series, we've done the client acceptance and continuance. We thought what we had considered, what we had to think about, what we had to document, and we decided, yes, we're going to take this audit, we are going to do this, or we're going to continue this engagement for this client as we may have done in previous years. Then we moved ahead to planning the audit. And in planning, we started by saying we need to obtain an understanding of the client, and we need to also then perform a risk assessment. And part of our risk assessment, or the result of our risk assessment rather, is then to say what is our audit plan and our audit strategy going to be, so that we are addressing the risk that we identified in the risk assessment process. And as a reminder again, all of these arrows going in all the directions. Why? Because planning is an iterative process. It's an ongoing process. And as you learn more about the entity, about what happened in the year, etc., you may actually go back and update your understanding, amend your risk assessment, amend your audit plan and strategy. So that really just to remind us of that element. Good. So then we start with understanding the entity. And we already started with that last time, but now we are going to very specifically then go and perform our understanding procedures or our pre-engagement procedures so that we can get an understanding of the entity to get us to the point of performing or identifying and assessing risks. And as a reminder for today, we said we're going to focus on the overall risk assessment, or the standard also refers to the financial statement level risk assessment, because ultimately we want to know where is there a risk that the financial statements may be materially misstated. So for the majority of today, we are going to consider ISA 315 revised, and this standard was last revised in 2019, so it's not all that long ago. Then it is 6 years ago, but if you think about some of the standards that haven't been changed since 2009, this is at least 10 years later than that. All right, one of the major changes for ISA 315 revised 2019 was really to say that we need to perform risk assessment in a bit more detail, and the result of that in our methodologies was that we more focused on doing risk assessment. We're more focused on what the risks are, so that when we get to the audit programs, the work programs, there we are really going to only respond to the risks raised. So it's really important that we get the understanding in as much detail as is necessary. In other words, what does that mean? We are going to spend more planning time. We are going to spend more time, more effort on doing the planning on our audits, because we can no longer just rush into the field work and, I almost want to say fix up the audit plan like we might have done in previous audits. So yes, we're also going to refer to the ISA 240, the fraud risk standard and things, but really this understanding the entity in terms of 315 is going to be where we are going to spend the majority of our time. If you haven't read the standard yet, it's quite a long standard. There's a lot of application material as well. So if you haven't yet gone and read it, please go and have a look at it at some point. I find it really helpful, actually. Now, again, maybe a war story from years gone by, but when I was studying in my undergrad, I had a lecturer who used to say to me, if you really can't sleep at night, go and read ISA 315. It will help you fall asleep very quickly. Now, as you can imagine, no one's going to read that standard if that's the message they got. I want to actually turn it on its side and say, if you are only going to read one auditing standard amongst all of those auditing standards, do 315. Yes, it's a long one. Yes, there's a lot of detail. I think there are 6 appendices. Yes, 6 appendices. But this is the crux of the audit, understanding the entity and identifying where things can go wrong, where things can be materially misstated in the financial statements, because that's what the risks are. That's where we need to go and focus our attention on, so that we can do the right audit work and get to the right audit conclusion. All right, so we're going with an attitude today of saying this is a really important standard and actually really gripping reading, rather than saying, oh my goodness, this is the one I'm going to read when I can't sleep at night. Okay, definitely not the thought I want to leave you with today. Good. Then, today we want to build a house. So when you build a house, or you could even possibly say, if you are looking at a house and seeing whether you maybe want to buy this house, perhaps even, what is it that we want to think about? We want to think about everything that was needed to build this house. We want to see if this house is built with a good enough quality, or if it will be built with a good enough quality, because we want to see that this house is actually going to last for very long, never mind last, but we want to know that by the time we put furniture in this house, that furniture will be protected against storms, against the sun, against the elements, basically, wind and whatnot. Okay. So we want to look at this house and see, where is it built? We want to consider, before we even think about what kind of bricks were used, what doors were used, is there a door? Can the windows close? Any of those things. Before we even want to think about that, we first say, where is this house built? What is the environment in which this house was built? Were they allowed to build the house here? What are the rules for building houses in this area where it has been built? What is the surface on which it has been built? So those things are quite important, first of all, to consider. Now, in the context of an audit, what we will consider here is very similar. To say, if we think about these little scrolls that you can see here, we will also say, for a business that is operating, and we need to go and audit that business, we ask ourselves, before I go and look whether there is any risk of material misstatement in the financials, which is essentially some of the furniture that's going to happen, going to be housed inside of this building, before we look at whether the roof is not leaking, before we look at whether the bricks are good enough and waterproof and whatever the case may be, before we look at that, we first need to ask ourselves, where is this house built? What type of business is this? What is the area in which it was? Which laws and regulations is relevant to this industry that the business is built in? Maybe to the area that this business is built in. We can think about who's in charge. Where we are building a house, or we're considering who built the house, and that tells us about questions that we need to ask, or who we need to ask those questions of. Here we are asking ourselves, what is the ownership structure of the business? How is this project managed? Who oversees this, and are they actually there themselves to check that the right things are happening? Or are we at a place where everybody just does what they want, and they will just hope that at the end of the day it's going to be a well-built house? All right, so what is some of the things we want to know? We want to know about the financial reporting framework of this entity. We want to know, are there any criteria that they need to meet in terms of specific financial reporting frameworks? We want to know what is the accounting policies, and whether those accounting policies are appropriate for, not just in terms of saying if I'm using IFRS or IFRS for SME or another framework, but also that when I am using IFRS or IFRS for SME or whatever framework I'm using, that framework is appropriate for my business, and that the policy that I might have chosen for my business is also appropriate. So I'll also go and think about whether it's a highly regulated industry. I will go and consider whether this business is made up of cyclical activities. You might have a business that has, let's say, sells ice cream. Now, there are a few people in this world who will eat ice cream even if it's absolutely freezing outside. But the majority of people are only going to eat ice cream in summer. When it's holiday, they might let go of their diet a little bit, but never mind that, they eat ice cream when they are hot. And when the sun is shining, or when they are walking next to the beach. So that will definitely be a type of business that's probably going to sell a lot less ice cream in winter. Okay, so that's what we mean by cyclical activities. There are normal or usual ups and downs in the business activities as part of the normal activities of the business. So what do they do in the rest of the time? All right. Is there any competition in the industry? Not that competition is a bad thing, but who are the competition? If it's a really big listed entity that's your competition, well, how does that actually influence how this business is competing with it? Something may be very relevant to South Africa, and these days it seems almost worldwide. Is there a sufficient and reliable energy supply? If we think about load shedding in South Africa, have they made a plan about that? What is that? How's that affecting their business? Well, never mind the business, the financials, can they still operate? If we think about our client, Wrap Up Manufacturing, that we've been working on, well, they are manufacturing plastic packaging. So they need to probably melt plastic into little forms. So that takes a lot of energy, a lot of electricity. So what happens when there is load shedding? How do they respond to that? Have they already made another plan, or are they really reliant on Eskom's provision of electricity? And ultimately, with all of these things, performance measures, any of these things, how do they affect the financial statements? Because remember, ultimately, we are auditing the financial statements. We want to see if the financial statements are fairly presented, if there are any material misstatements. All right. Next up, then, we can also consider the structure and ownership and governance of the business. So we need to understand who owns the business. Yes, ultimately, who owns this business. We've got to see who's running the business. So the person owning the business is not necessarily the one that is running or managing the business. Who should we speak to when we've got questions about how is this house built? How is this business run? Who performs what, etc. Is there perhaps one very dominant individual in the business? Now, well, that could be a good or a bad thing because that person can really take control of everything that needs to be done. But at the same time, it could also potentially give rise to a risk of management override if that person is very dominant and runs everything and basically just overrides everybody else. There is a risk that that person might actually manipulate things happening in the business, whether that is how they comply with laws and regulations, whether that is how they do manufacturing, consider things like health and safety in the production system, and also, of course, what are we concerned about? The financial statements, in how they disclose and what they disclose or don't disclose in the financial statements, and whether that may be materially misstated. All right, so we might also consider, so we've spoken about who owns the business and who runs the business. We have the ownership structure, the management structure, and then we also have the governance structure. So governance is those charged with governance, those people who have to see that things are running smoothly, that things that should be done is done appropriately and correctly. So sometimes we'll have what we just loosely refer to as owner-managed businesses. Now, owner-managed business is basically where the shareholders are also the managers of the business. That's great. But who are the directors? Well, sometimes, again, these might also be your directors, especially like a one-man show, or, you can have a variety of instances. But you also have instances, probably more where you've got a bigger, obviously listed type of client, but even bigger ones, where your persons who are managing the business are not those who are charged with the governance of the business. So you will have a financial manager and you will have directors who have to oversee that the financial manager is doing what they should be doing. So in terms of the directors, which are usually those charged with governance, not always, we'll consider that at the client, but your directors could also be executives, in other words, part of the business as well. So the financial director or someone like that who's also part of the operations, very much involved, or an executive if you want. And then you could also have non-executives. So to that non-executive person charged with governance, let's call it a non-executive director for ease of reference, we could also say, how do you know that management is actually doing what they should be doing? How do you know that management's financials are appropriately presented? How do you know that they're complying with everything they should be doing, that they're all acting ethically, etc.? So basically to say the governance of the business, who is also seeing that what must be done is being done. In terms of the performance measures, there we want to ask both management. So maybe a good example also to explain the difference between those charged with governance or the directors and management is that a lot of the strategic decisions are made by those charged with governance or the directors. It's almost like they set the strategy for the business and then check that it gets done. But the management are the persons or the people who are responsible for executing or rolling out that strategy. So those charged with governance, the directors in my example, are responsible for checking that management is actually doing what they should be doing, that management is performing. So we can often then ask, again, if these are two separate groups of individuals, to ask management to say, what do you look at management to know if the business is performing well or not? That will give you some examples. And then we can also ask the directors, and especially if there are those non-executive directors, to say, how do you know? What are you looking at? What are you focused on when you are trying to determine whether the business is performing well or not? And they will then give you examples of things that are important. So, for example, let's say the client has financing with a bank, and part of the requirements of that bank is to have debt covenants or to meet certain debt covenants. So those are ratios and things that they need to meet. Now, if management or those charged with governance says it's very important that we meet those debt covenants, because if we don't meet those, and we don't meet the targets, then the bank can actually pull our finance. So it is really, really important that we actually stick to those. We want to retain that financing. We need that financing. So it's important for us to meet those debt covenant requirements. So what does that tell us? Well, they're going to be really focused on that. And then it's possible, I'm not saying it is, but it's possible. And so therefore there might be a risk for us there to consider to say, is it possible that when those debt covenants, I almost want to say, come under threat, when there's an indication that those debt covenants may not be maintained, is it possible that they may be manipulating figures to actually make it appear as if it is maintained? So not necessarily happening, but there is potential that figures may be skewed to give the right picture of the company, even if that is not the truth. And that, of course, is what, from a financial statement perspective, that is something that, of course, we do not want to happen. All right. Then the last scroll, even still a lot of things for us to consider and to understand, is the business model. How is this business financed? Are they getting financing from the owner? Are they getting financing from the bank, maybe from a related party? How is that done? What are their plans? Are they planning expansions of the business? Maybe they are restructuring. What will that tell us? Well, if they are restructuring, there could be complex transactions. If they are buying another business, expanding, then there might be business combinations, and those could be complex transactions. And when a transaction is complex, the standard tells us that that complexity gives us an inherent risk potentially. So it's an inherent risk factor, is to say if there are complex structures, complex transactions, there is a potential risk of material misstatement of those complex transactions in the financial statements. All right, it also includes the IT. Now, in this case, it really is about how IT supports the business structures and the business operations. So we have already, in the previous session, session 2, we did consider what IT and processes the client uses. We'd already considered whether the IT is complex or not, and whether we need a specialist, etc. But here we are asking ourselves whether the IT, how does IT fit into the business? Does the IT structures that they have in place support the business? If they want to do, let's say they want to do e-commerce, is their IT set up such that they can actually do that, or do they actually not have that? If they want to have integrated systems, what package do they use? Does that package actually allow for integration, or do they need to upgrade everything in order to get to a new software package that will allow for them to have this integration? So IT these days, I think we are all convinced that IT is really the whole process. You can't really do processing anymore without IT, but it is important that we understand how that supports the business, as I've mentioned. All right, so these scrolls all help us to understand the business, but also help us to identify events and conditions that are relevant to the entity. It provides us for a context, as we said at the beginning with a story about the house, also the area in which it is situated, the foundation, the conditions in which it is built. If there's a lot of rain regularly and there are floods, maybe, then how is this house built to protect itself against those floods? That's the questions we're going to start asking ourselves. All right, so that's in terms of basically inherent elements that we are gaining an understanding of. Next then, as we move to the internal control elements, we then start looking at the actual house now. And we start with the roof, because when it starts raining, we want to make sure that this roof is protecting the furniture inside, protecting even the walls. You know, there's often, you'll see the roof has a little overhang over the walls. That is built with a very good reason, because it's also helping the walls to stay dry. Because otherwise, it would just rain in from the top and the wall would already be wet, never mind the fact that it's raining in from the sides, but also from the top. So in terms of this roof, we want to make sure that this roof was properly built. Now, we want to make sure that the roof is strong enough and is kept in place, and that it is functioning properly. So, you know, you want to see that there are no tiles missing on your roof, and that somebody is actually checking and seeing that the roof is intact. Not necessarily a pretty color, but at least doing what it should, functioning properly. So in the internal control context, there we are focusing on the control environment, and we are very intentionally using this as or referring to it as a roof, because another context or another option could be to actually just call it a foundation. A lot of other people would refer to the control environment as the foundation of the house, and you can only build on that. But we're specifically wanting to think about this as the roof, as I said before, for in case there's rain or anything like that that falls on it. So apologies. So the control environment is really the overarching way in which things are done. So we want to make sure that the control environment is setting the correct space, if I can call it that, where the business can operate appropriately. Let's look at some examples. If the owner communicates to staff that he doesn't want to pay unnecessary tax, right? Unnecessary is also a relative term, and it's also about how he might be communicating that. So that filter, or that element, that context, where everybody knows this owner does not want to pay tax if he does not have to, that context will filter through to the rest of the business to say, well, you know what, the owner, if I tell him there's something wrong, he's not really too worried as long as we don't pay extra tax. If there's a problem with the IT, if a client is upset, any of those things, you know, the owner doesn't really worry too much. He's just worried that we don't pay too much taxes, or he's just worried that the money comes in. That will kind of create a culture. It will create an attitude to say, well, if the boss doesn't care, then I'm not going to care either. You know, that's ultimately what's going to happen. If the owner is, let's say, goes on holiday very often and is really not checking that things should be done, is really not checking that the quality of the products are appropriately done, etc. I mean, at some point, the staff is also not going to care about getting things done appropriately. Of course, except for that tax, eh? They don't want to pay too much tax. But other than that, it's kind of going to fall away. People might not be getting to work on time. They might not be too worried about getting the quality of the products done well. And so overall, the business is just going to be poorly managed. And what are we focusing on? We're focusing on the financials. And so the risk that whoever is in charge of preparing those financials might also just not be done so well. He or she might just not worry about getting it done as accurately as possible, as up to date. The figures might not necessarily tie up. There might be things that doesn't make sense because you know what? Ultimately, it doesn't matter as long as we're not paying too much tax. Okay, I've said that not paying too much tax enough times now, but you're getting the message. Right? So we're looking at that attitude. We're also thinking about how does management, let's look at a few of the examples in a bit more detail. How does management carry out oversight? So how do they ensure then that everybody else is also doing the right thing? So we've got the right client, we've got the right management or those charged with governance. They really are trying to create a culture of integrity. They're trying to make people live the right ethical values. They are there, they are checking the quality of the products, etc. But now, how do they ensure that that is also done by everybody else? How does the non-executive director or the directors, how do they ensure that people are doing the right things? So as directors, we can have these things in place and we can say what must be done, but in some other way, they need to also take responsibility for the system of internal control, for making sure things are happening as they should. Well, how would they probably do that? They would probably rely on questions asked of staff, of management, reports sent to them, things like that, so that they really can get feedback of what's happening. Okay. Then how does management ensure that people are doing the right stuff, and when they're doing the right stuff, that they're doing it correctly? So I've got the storeman actually in charge of the stock. I don't have the receptionist necessarily doing that. And is that appropriate? Do I maybe need someone else at a higher level of staff, etc.? So that kind of thing also to emphasize that the right person must do the right job. And really define that out. And that's where you're going to have to maybe go and look at organograms and organizational structures, seeing how you have actually communicated to people what their jobs are. How do their actions fit into the puzzle and contribute to the success of the company? You can probably think about things like job descriptions and key performance indicators, things like that, and really help them to understand where they fit in. How do they attract the right people and keep them there, retaining the staff? So what is their recruitment processes? How do they ensure that where there are people that are doing well, that they can actually keep them in the sense of either giving them bonuses or giving them good salary increases, giving them additional training, giving them opportunities for being promoted, things like that. So how do they ensure that the right people are doing the work? Why? Because if the right people are doing the work, you're probably going to get the work done well, correctly. And so your risk of material misstatement is going to be reduced. Then how do they hold individuals accountable to the responsibilities? Well, that then the rewards should ideally, of course, be linked to what is expected of them. Again, those bonuses and those things. Okay. I just want to see that I don't have anything else. Yeah, okay, so that's good. That's pretty much the control environment. We've spoken about a lot of things. Now, remember that when you're getting this understanding, when you're asking these questions, you are asking these questions and getting the understanding, not in order to just complete a tick list and say, yes, I've asked these 20 questions, I've filled in the little fields. You are getting this understanding to be able to identify where there's a risk of material misstatement in the financial statements. All right, let's see what the rest of our house has in store for us. So if the roof is the control environment, the other elements of internal control are then the risk assessment or the client's risk assessment process, very important, the client's process of monitoring, and we will unpack what that's meant by monitoring, as well as the client's information system and communication within the business, and then lastly, control activities. Now you'll notice that we've got these two levels. So risk assessment monitoring being at the top, and then this middle line in our house is control activities and information system and communication. So the standard actually refers to the first three, control environment, risk assessment, and monitoring, as being almost more indirect control. So they're not directly affecting the balances, the transactions recorded in the accounting records, but the more direct ones are the control activities and the information system. So In terms of calling them more direct, that's also where we will be able to link those control activities and the controls more directly to the individual classes of transactions or account balances. So in the next session, when we consider the risk assessment at assertion level, we will unpack these two elements of internal control in more detail. You'll also remember in the agenda, I said we're going to address only 3 of the 5. So these are the 2 that's carrying forward to the next session. But then for today's session, we've already considered control environment. Next up then is the client's risk assessment process and then monitoring process. Now, I've said this twice now. The client, the entity's risk assessment process. Your client's process for identifying where things can go wrong in their business and what to do about them is not, oh, I've got an auditor. The auditor will come and check it. That is not the risk assessment process. You are not their control activities. The client should, and I can almost bet you probably has some other way, either more or less formal, in which they will go and say, where can things go wrong in my business? And where I then identify something that could go wrong, in other words, a risk to my business, what am I doing about it? How am I addressing that risk? Mitigating that risk could even be a word. Now, if you've studied a little bit of risk assessment and risk management, you will know that there are all these fancy things. You can have a risk register with lots of risks. You can have those risks assessed in terms of a little table or a matrix, and you can have levels of risks and people who are then accountable for addressing those risks, process owners, and all kinds of fancy terms that you can throw around. But that's not necessarily required or necessary in all instances in order to have an effective risk assessment process. So if we take a smaller type of business, for example, they can probably, if you just have a discussion with them, they can probably tell you, yes, in our business, in wrap-up manufacturing, things can go wrong in my business if, let's think about it. If my clients stop paying me, or if my suppliers insist on me paying them sooner, that's going to lead to cash flow management. And if I've got cash flow problems, it means that I also can't pay let's say my rent, or I can't pay the salaries for my staff and things. So yeah, cash flow really could become a problem for my business. And you know what cash flow problems look like? They just basically snowball into one big problem. So yeah, I need to look after my cash flow. Great. So I have applied my mind to where can things go wrong in my business. And at the same time, I've also said, what am I doing about it? So what am I doing about it? And then the client can tell you what they've put in place. They always make sure that the customers pay on time. They negotiate favorable terms with his suppliers, etc., etc., etc. What do they do? They might even remember that debt covenant. They might even have an overdraft, which they are using to dip into when they need to. So that is then the response. How are you doing this? Now, we'll see also later on, but what is important is that we need to also not just ask the questions of where can things go wrong. We don't just ask, let me just actually show you the next slide, which is quite nice, to show you the client identifies the risks relevant to financial reporting. We can, of course, start outside with general business things, but then getting to, as auditors, we focused on the risk assessment process for financial reporting. Where can things go wrong? That cash flow management, and then to say how big an impact could this have. So does this mean that I could actually lose my whole business? Could the business actually close shop if my problem is big enough? And well, yes, no, maybe, if something, if not something. And then we say, how am I going to actually address this risk? What am I going to do? Oh, let me just move my little light. What am I going to do to ensure that this risk does not happen, or if it does happen, how am I going to save my business? So those are the 3 steps. We might even have the client say, well, you know what, cash flow is not such a big problem. I'm okay on cash flow, I'm managing it appropriately, but you know what is a problem? I've got one big customer that buys 70% of the stock that I sell. And if I lose that customer, that is going to be a problem. I'm really going to have a problem, because then I'm going to have 70% less sales. I'm going to sit with a lot of stock, which are basically the raw materials I bought in just for him, etc., etc. You can now imagine your whole long story. So, of course, then you're going to say to the client, what are you doing about it? How are you ensuring that you either aren't too dependent on that client, or that you don't lose that client? And the client's immediately going to say, well, you know what, I have a very good relationship with that client. I always maintain a good relationship. Whenever they send through orders, we ensure that those orders are actioned immediately, etc., etc., etc. So we are addressing that risk. We are constantly working on maintaining that relationship. Let's say the client says, yeah, when I manufacture items, I deliver the items to the client. So I don't use couriers or anything like that. I actually have my own delivery truck, and we deliver the stuff. I do think that we might have a problem if my truck breaks down one day because I don't have a backup truck. I've only got one truck that I use for deliveries. So yes, that could be a bit of an just a bit of an administrative nightmare. Not the end of the world, because if it really does happen, I mean, I'm not going to buy a second truck for in case the truck breaks down. But thankfully, we've got South Africa, we've got such a good network now of all of these couriers. So you know what? If my truck breaks down and for 2 days I have to send it in to get repaired, I'll just quickly get the services of a courier and they will do the delivery for me. So it's not actually going to affect my financial reporting. It's not that significant, but we can see that they have applied their mind. They have thought about where can things go wrong, how big a problem could it be, one, for my business, two, in the financial statements, and have they addressed it. So we're not so much focused on the, let's call them business risks. We are primarily focused on the ones that will affect the financial reporting. But now remember that if that truck breaks down, or if there are big things, it could potentially lead to going concern risks. So these could then be events that could actually cause us to have a material uncertainty about whether the entity can continue to operate as a going concern in the foreseeable future. So those ones we would want the client, even though it would be a business risk, we would want the client to have addressed so that we can conclude that the going concern risk at least has been addressed. All right, so those are a few examples in terms of the entity's risk assessment. But what I want to stress again, it is not our, as auditors, responsibility to identify where things can go wrong on the financial statements or in the business. And it is not our responsibility as auditors to go and see what needs to be done to address these and to check that it has been done. That is the client's process. Okay. Yes, as auditors, we come and we see where are the risks of material misstatement and we go and audit them. And that might involve performing similar procedures to what the client would already have done. But primarily, there are a few people in the profession that talk about the economic, what do they call this now? The ecosystem. Yes, the financial ecosystem. And so when they refer to the financial ecosystem, the auditors are just one part of this ecosystem. And the preparers of financial information and the business owners, they are also part of this ecosystem. So as auditors, we audit what should have been done and that it has been done. It is not primarily our responsibility to perform or to execute the risk assessment process. That's why the slide also says the entity's risk assessment process. Right, next up, let's have a look then at the monitoring. So monitoring is not just something that happens at the end of a process. This really should be done by the client to, firstly, understand that the client's risks have all been identified. So in other words, there's not anything left potentially. But secondly, and probably more importantly almost, is to say that the controls that the client has put in place in the risk assessment process, that last little part of our slide said, address the risk. So that response, we want to know that that response is in fact sufficiently addressing the risks that the client has put in place. So we want the client to actually say, well, if I thought that my delivery truck is maybe getting old and if it breaks down, I need to just know that there is a courier guy available for me, then maybe I'm going to start considering who the couriers are. I'm going to maybe start considering, start building a relationship with one of the courier services. I've already mentioned the important customer that we want to maintain that relationship. So from a monitoring perspective, I would want the client to at least every now and again say, are we still looking after our customer appropriately? What is the relationship like? Do we need to do more? Do we need to do something differently? Or is this working? So monitoring in this internal control process covers both an ongoing evaluation of the effectiveness, but also a separate, almost going to say a specific time evaluation of the effectiveness of the controls, and then also to identify where there are deficiencies, and then of course to remediate them. So to fix those problems where they do occur. If it's a bigger client and they use an internal audit function, either their own one internally, or they maybe source that out to an external service provider, well, that will also be part of the individuals or the team that performs the monitoring. Right, so as auditors, we want to understand not just what you are doing and how you concluded that the controls are working. We also want to understand the source of the information that you use. So if I say there needs to be 2 people that approves the purchase of any fixed assets, for example, then I'm not just going to be happy with the client telling me, how do you know that this is being done? And he says, well, I asked the 2 people who have to do that, and they said, yes, that's the process they follow. Okay? Because obviously they know that's the process they should follow, so they're obviously going to say yes. So are we also is the client, again, the clients doing the monitoring, are they also checking the processes? Are they also looking at documentary evidence to say, yes, this is in fact what's happening? Or they might be looking at something else. So I'm not saying they always have to look at documents, but just also consider how are they, I just want to say, considering whether the controls are done. How are they making this evaluation? And is the information that they are using, the source of that information, is that sufficient or not? All right, and then in our little green block to say that the controls that relate to specific risks need to be monitored, and the monitoring will assess whether the controls within each of the components are operating as intended. Those components being the 5 parts of our internal control, and there specifically, as we mentioned then, are the controlled environment controls happening as they should? Is our risk assessment process being done? And then, well, the 2 parts for the direct controls, the control activities, and the information system as well. So monitoring involves the whole element or the whole system of internal control. So part of what we need to consider about the entity is also the laws and regulations that the entity needs to comply with. And there's even more than just the 315 standard. There's also a specific standard, ISO 250, that talks about laws and regulations. So let's just consider what is required in that regard. Oh my goodness, let me just show you the right slide before I make a mistake there. Good, so what does ISO 250 ask of us? Now, what's quite nice almost is you can almost start, if you imagine like a little zoom lens, you can start outside looking at the wide world, I almost want to say, and the white slide that we have in front of us. And then as we start to understand which laws or regulations the entity has to comply with, or that is relevant to the entity, we zoom in to the purple block on the slide. And then we are also going to go even further and zoom into the yellow. But let me explain how or when we're going to do this. But maybe if you use that, it can also help you to see how you start by looking at almost thinking about which are the laws and regulations that the client has to comply with, then going a little bit nearer, doing a little bit more work, and then ultimately going and really focusing your audit effort on the ones in the yellow block. All right, so let's think about this. So in terms of considering which are the laws, the legal framework, the regulations, the requirements that the client has to comply with, if we identify or when we identify those laws or regulations, we will need to, as you can see in the purple block, obtain a general understanding of that regulatory framework or that law, that act that the client needs to comply with. And then also just to get an understanding of how the entity is complying with that legislation. So how do they ensure that they are compliant? So that's already a bit of a zoom. And then next up, we consider, again, remind ourselves, we are auditing the financials. So yes, we want to know the general framework, but then going further to say which are the laws or regulations that the entity has to comply with that will have an impact on the financial statements. And that's when we then move into the yellow block to say for those laws and regulations that have a direct effect on the left-hand side, that have a direct effect on the financial statements and the determination of the material amounts and disclosures in the financial statements, those will be what we see now in the left-hand side of the yellow block. But there could also be laws and regulations that impact the financial statements where those are fundamental to the operating aspects of the business, the going concern of the business, or where the client has to comply. Sounds a bit strange if you say that, but basically to avoid material penalties. Or if we say it the other way around, if they don't comply, they could very well be given material penalties. So those will then be the 2 groups, categories of laws and regulations that we are going to be spending a bit more effort on than just understanding the framework and checking how the entity is compliant. So let's have a look then at those. Right, so in fact, let's just go back again and just think about some examples. Sorry, I'm jumping back and forth now, but let's just think about this. So laws and regulations, if you have wrap-up manufacturing, the general laws and regulations that the client has to comply with in a context of, let's say, a South African environment, there are things such as, well, if it's a company, the Companies Act. It has to comply with the Income Tax Act, the VAT Act. It has to comply with the Skills Development Levy Act because it's got employees in place, the UIF Act, the PAYE, all of those things around employment, basic conditions of employment, all of those ones. And then also the Occupational Health and Safety Act, again for the employees, and you can probably think of a few others as well. Right, so those will all be the ones that we need to get a general understanding of the framework that's required, how's the entity complying with them. And then we go and we say, which are the ones with a direct effect on the determination of material amounts and disclosures in the financials? Now, There we can probably say something like the Skills Development Levy Act, the UIF Contributions Act. Those ones, there's going to be amounts in the financials that will have been determined by their compliance with that, but they're not really going to show material amounts or disclosures in the financials. And well, I also don't know if we can necessarily say there will be material penalties. It definitely won't affect the going concern of the business or fundamental to the operating aspects of the business. So it's probably good enough just to leave your Skills Development Levy and your UIF in the purple block. What are we taking with us into the yellow block? Things like the income tax legislation, because that will determine probably disclosures, but also the amounts of tax payable and tax owed and the income tax expense in the business, in the income statement and in the balance sheet. The Value Added Tax Act will also have a material impact on the financial statements in terms of the sales amounts, all the purchases and things, and again, the VAT payable or receivable from the receiver of revenue. In the South African context, we also have the South African Companies Act that has a requirement for specific disclosure of the director's remuneration. So again, a material disclosure in the financial statements, even if it's just qualitatively material. So those will be examples of what would be on the left-hand side in the yellow block. And if we think about the right-hand side, fundamental to the operating aspects, could be something like, if we think about avoiding material penalties, maybe the Health and Safety Act. If we think maybe about other businesses, it could even be something like a mining license that you need before you can start operating a mine. Right, so those are some examples of where they could fit in. So now that we've got some examples linked to the blocks, let's now go and think about what it is we need to do in these yellow blocks. So when I've either got a direct effect or where those legislations or laws and regulations are fundamental to the operating aspects, affects the going concern, or must be complied to avoid material penalties. So what is the extent of the work that we need to do? So for those ones, of course, we will always remain alert throughout the audit to identify any non-compliance. So you're not just going to say, oh, I've done the work, now I don't care if somebody is, paying a bribe or not submitting the PAYE return or things like that. I've already done what I needed to. If they now do something wrong, that's okay. No, of course, we can't just turn a blind eye. So throughout the audit, we will always remain alert to non-compliance. And if we do identify any possible non-compliance, remember that there are two main things that we need to be aware of. First of all, the no-CLAR provisions in the Code of Professional Conduct, so the ISBA or the IRBA or your professional association's code. If it stems from the ISBA code, there will be a section there, non-compliance with laws and regulations, which we've really just shortened to no-CLAR. And so there are requirements depending on your role in this entity, whether you are the accountant in business, of course, in today, we are the auditor, whether you're part of the audit team, whether you're audit partner, what your responsibilities are in terms of responding to no-CLAR. And then in the South African context, the Auditing Professions Act requires you to report reportable irregularities to the IRBA. So without spending too much time on that, I wanted to just first say, remember that if you identify non-compliance, you have to report those. All right. And of course, the big thing is that with a RI, in terms of the Auditing Professions Act, you're not allowed to first chat to the client. You must first report and then you can go and discuss it with management, whereas no-CLAR steps do allow you to discuss with client, to have a discussion with the client to basically clarify and understand what's happening, and of course to encourage them to fix whatever might not be non-compliant. So yeah, when you've got an RI, you need to just get it the right way around. All right. Then if we've got that purple block where we first say there's a law or a regulation that needs to be complied with, and they will have a direct effect on the financial statements. We've got this arrow going up that says, now I need to do a lot more work. I need to actually obtain sufficient appropriate audit evidence about the client's compliance here. I need to actually perform field work, audit work, to test the client's compliance. And that's where we will test that the client's income tax is appropriately calculated, disclosed, etc. We will check that the client is correctly treating the VAT in invoices and so forth. We will, in the South African context, again, we will make sure that the client has disclosed the director's remuneration in the financials. So those are those three examples then for today in terms of direct material effect on the financial statements. And there you are going to do audit work. All right. Good. Then next up, if we have still in the yellow block, but we've got these laws or regulations that are fundamental to the business operation or affects the going concern or where you are complying in order to avoid material penalties. In those cases, there are specific procedures that the client has to perform. I'm sorry, not the client, that we as the auditor has to perform to ensure that we identify any non-compliance. So again, you can't just say, how's the client complying? No, you've actually got to do a little bit more to identify any possible non-compliance, of course, if it's the case. Hopefully it's not the case. So what would those be? That is where you need to make an inquiry of management and those charged with governance about how they're complying, which we've already done as part of the purple block, but then also to inspect correspondence if there is anything to confirm that they are in fact complying. So if I think about some examples, it might be where they've submitted a specific return of some sorts, things like that, to just check that the client says how are they complying, and they have in fact done that. I'm also thinking about, now the word has just left me, but one of these labor legislation things where you need to actually like submit a little return thing for, I think, injury on the job or something. The word has literally just left my brain. But there also, you'll check that the client has in fact submitted those returns. All right. That's pretty much then laws and regulations. So hopefully the image of starting wide and then starting your lens wide and then actually zooming in further as you need to perform more work will help you. And then also when we look at the working papers, that will also hopefully help you in a bit more detail. We then move on to the fraud risk assessment. ISO 240 is a very important auditing standard. And as you'll see also, there are quite a few required responses. Thank you for him. Workman's compensation is the word I was looking for. You have literally, I'm so relieved now because I thought my brain was just getting stuck. So thank you very much. Okay, let's go back to fraud risk assessment. So fraud risk assessment is crucial in an audit. I'm going to say it again. Fraud risk assessment is crucial in an audit. In one of the earlier sessions, I had a question that said, are we required to go and look for fraud, or are we just auditing the financial statements? And the answer is we are still just auditing the financial statements. With a but, remember that the expectation of the public is that auditors are going to pick up any and all wrongdoing. And that's why we've got the long audit report to explain that an audit is not looking at every transaction. An audit is not looking for every bit of fraud. So in an audit, yes, we are alert to fraud. Just like we said, with laws and regulation, we are alert to non-compliance. And if we identify any of those, then we react. And that's the same thing with fraud. With fraud, we are alert to, we are aware of the fact that fraud could happen in an audit. And if fraud happens and it affects the financial statements, that would obviously result in a material misstatement of the financial statements. So we want to be alert to those risks of material misstatement in the financial statements. There is therefore a responsibility on us as auditors to really remain alert, to do a proper risk assessment of whether there is a risk of fraud happening in a business. So thankfully, we have a bit of a tool. It's not just a, oh my goodness, where do I start? So our tool is a so-called fraud triangle. Many of you may already be familiar with the concept of the fraud triangle. But where does this come from? So a number of years ago, many years ago, there were a group of people who interviewed fraudsters, people who committed fraud. And they were trying to find a commonality or common things that were there to say these things are possibly indicating fraud. And of course, as you can see now, we've come up with something. So obviously, we did identify commonalities. But the person or the team that then concluded these interviews basically came to the conclusion that normally 2 or more of these 3 elements are normally present in a scenario where fraud takes place. So let's just unpack these 3 things. First of all, incentive. So incentive, I've also often heard the word pressure. So incentive could almost be the positive and pressure could almost be the negative, although you can probably interpret them both ways. But an incentive is basically to say, from a positive perspective is, you know, if I do this and the figures look better, I'm going to get a bonus. It's going to be to my benefit. There's an incentive for me to commit the fraud because I'm going to benefit from it. Or if we think about it more almost like a negative, a pressure type of thing, it could also be a situation where your boss says to you, listen, you better do this because I don't want people on my team who aren't team players. If I have to pay more taxes, sorry, I'm back onto my more taxes scenario. If I have to pay more taxes, or if this happens, or if that happens, then you know what? I don't know if there's going to be a job for you here anymore. Right, so there is a pressure and almost a negative thing to say, if you don't do this, I'm going to actually just let you go. Or you can also see it as an incentive to say, if you want to keep your job, you kind of have to do this, right? Incentive, pressure. There's that, I don't want to call it a motivation because it's definitely not a motivation. It's more a pressure, a thing that drives you to actually commit the fraud. It could, of course, just be plain greediness. Okay, but it could also be something that might almost make you sympathize with a person. Say, you know what, shame, she didn't want to lose her job, so maybe that's understandable as to why she did it. But also, we still need to be ethically strong. So that it really is a difficult thing. All right, the next one I want to look at then is rationalization. Now, rationalizing is also another word for that is perhaps justification, almost explaining why it is okay for me to have done this. Why, yes, it's wrong, but I didn't have a choice. But I really needed this job. But I can't afford not to have a salary. But look at everybody else. Everybody else is doing this. We're going to see in an example just now about a financial thing to say, everybody else got bonuses. I didn't get a bonus this year. Things like that. So why is it okay for me to commit fraud because this happened, that happened, this didn't happen, that didn't happen? Right, so that's that part. And then lastly, and I almost want to say this is probably the one that's almost always there, is opportunity. And opportunity to me equates to a lack of controls. There's always a gap in internal control when there's an opportunity. Because if I have all my gates closed up and there's no gap for you to actually get into my system, to commit the fraud, you can have all the incentives in the world, all the rationalization in the world. If you don't have an opportunity, you can't actually commit the fraud. Okay, of course, it's not just you as an individual. You can obviously work with other people. And then if you guys together then have that opportunity, then again, then you've got the opportunity to commit the fraud and the incentive and whatnot. So those are the three parts. You must have an opportunity. There's got to be a gap in the system. I almost want to say a hole in the gate for you to get into the field or the whatever where you want to get into, whether it's the IT system or something like that. There's got to be an incentive or a pressure on you to commit it, and you must be able to rationalize it. I almost want to say, I really hope that nobody can actually commit a fraud without thinking there is a reason why it is okay for them to commit it. Okay. I saw something earlier the week to say, all of our intention is actually to do good, to do the right thing. So probably then that a person who commits the fraud believes it's the right thing to do for a very good reason. Whether we believe it's a good reason or whether that belief is right or not, but that's the thing. All right, so let's look at a story and then unpack these three parts of the fraud triangle. Let's just wait for the curtain to open. There we go. Story time. Cindy is the payroll administrator at a large company which employs more than 300 employees. The payroll is prepared monthly. Cindy's boss, Jeff, performs a high-level overview of the payroll. His view is that he doesn't want to redo the payroll if that's what he hired someone else, being Cindy, to do. This overview is often just a quick comparison, month on month, and maybe one or two questions for Cindy. Her duties includes drawing a report from the payroll system, which is then sent to the bank to make individual payments. The payroll is quite complex, but Cindy is very experienced and she's been with the company for many years. She's always willing to step in wherever needed, and she has a great attitude. Great stuff. Part 2. In August, Cindy accidentally includes a test employee on the payroll sent to the bank after testing something on the payroll system. This was only picked up because the bank notified her of the payment that didn't go through. And then when she saw why it didn't go through, she obviously saw, oh, that's my test employee. Then during September, Cindy is informed that admin staff at the company would only be given an inflationary increase. Operations team would be given 8% and the executives 10% increase. The company has had a record-breaking year financially, and in previous years, increases weren't that great either. Cindy is so upset by the lack of increase that she forgets to remove the test employee, and the same process happens as in August. In other words, even though Jeff reviewed the system or the report twice, August and September, he missed both of those. Cindy has twins who are both going to university next year and had hoped an increase would assist her in paying for the university cost. Right, so that's our story. Now, let's go and apply our fraud triangle and see, are there incentives, opportunities, or possibly rationalization for her? So now is when I would really like for you to please participate. So I'm going to launch some polls for us. So if you've been, I don't know, sitting further from your laptop or falling asleep or something like that, please go and have a look at the polls. I'm going to launch them just now, and then we can see what's going to happen here. All right. So the first poll is asking you, Jeff performs only a high-level review of the payroll. What does this represent for Cindy? Thank you for everybody that participated. So what we can see now is that 63% of you said there's an opportunity. Some said rationalization, some incentive. So opportunity is exactly the right thing. So why is this an opportunity? Well, because Jeff doesn't actually look at this in detail, and she's seen this twice now. 2 months in a row, there was an extra employee on the report, and Jeff didn't even notice that this person was on there. Now, those of you that might be testing, you'll know that a person, when they test software, they often test using the same name. So it might be Joe Soap employee, or it might be test employee, or it might be Mr. Testing, or whatever. You're going to come up with a name that you use to clearly and easily spot that person, so that also if you're reviewing it yourself, can hopefully say, oh, I forgot to remove Joe Soap or my test employee or whatever the case is. Jeff didn't even see that. So it's clearly representing an opportunity for Cindy to say, if she changes something on the payroll system, Jeff will probably not see that. Right. Good. There's another one. Let's have a look at the next slide. So the next one says, Cindy works hard. She's loyal and she steps in whenever needed, and the company has had a great financial year. What does this represent to Cindy in this scenario? Very interesting indeed. So we've got 51% saying this is an incentive for Cindy to commit fraud. We already know she's got an opportunity. Then we've got 37% saying there is a rationalization for her, and 12% saying there's an opportunity. So we've got the opportunity already that she knows Jeff doesn't pick up mistakes when they are in the system. So this is not then an extra opportunity. This is just then for her to be able to rationalize or justify why it would be okay for her to, well, add an extra employee perhaps, or to perhaps just increase her own salary somewhat, because she works hard, she's loyal, she goes the extra mile, and the company had a fantastic year. I mean, there's money in the business, and they don't want to actually reward the hard-working employees. That is justification enough for her to say, I deserve a better salary increase. I deserve something more because I've worked for this company for many years. I know they've done well. I really earned a better salary increase. Right, so that could possibly be a justification or how she rationalizes or reasons around that. Good. Then next up, let's see the next one. I get all excited when I think about this, but I don't know if that's a good or a bad thing if you get excited about fraud, eh? Lastly, we know that Cindy has twins that are going to university next year, and she has to find the funds to actually pay for the university fees. Not just one child, but 2 of them. What does this represent for us in this possible consideration or this possible indicator of fraud in our fraud triangle? Cindy's twins to university next year. She must get the money somewhere. What is that? Is that an incentive, rationalization, or opportunity for her? So we have 58% of you saying this is an incentive for Cindy, 28% saying rationalization or justification, and then 14% saying this gives her an opportunity. So this is indeed an incentive for her, a pressure on her to say, oh my word, where am I going to find the money to pay for my kids' university fees? I already have so much money that I need to spend on everything else, maybe their matric dance or whatever else you can imagine. You can make up your own story in your mind, but to say, you know, already I haven't got an increase as I should have. I worked so hard. My rationalization, my justification was there to say, I give it my all at work and they don't even actually reward me appropriately. And now I will have this additional pressure, additional incentive. I want to give my kids a good university degree. How am I going to fund this? Well, I know Jeff doesn't look at the report. So maybe that's the way for me to actually finance the university fees, is by just adding a little bit to my salary every month. All right. So that is an interesting lot. So that's really the way to then say, okay, in this case, we've now identified that Cindy has an opportunity, incentive or pressure, and also potentially a reason to justify or rationalize why she can pay herself a little extra or commit a little bit of fraud. I'm not saying she did, okay? Nobody said she did steal money, but that's just being alert to situations and knowing where perhaps something could have gone wrong. So what does the standard say? Whenever we have a fraud risk is a significant risk. And when there's a significant risk, it means it needs special audit attention. We need to respond to that risk, and we will then go and record that risk and go and test it in more detail. The example we had here was actually at an employee level, but we were basically illustrating that, sorry, not the employee level. The example we just worked through is at the employee cost or salaries level, so more at an assertion level, but it still clearly indicates the illustration of the application of the fraud triangle in terms of incentive, rationalization, and opportunity. All right, thank you for your participation there. Now, let's move on to the presumed significant fraud risks. The fraud standard, ISO 240, has basically 3 standard or default fraud risks, presumed fraud risks. The first one we're going to look at today because it is at the financial statement or overall level. And then there are also 2 more that is at the account or assertion level that we will look at I think next week, but definitely the last week. I almost seem to think we're going to look at those 2 fraud risks in the last session. So for today then, at an overall level, the presumed significant fraud risk is the so-called management override of controls. And the standard then has 3 standard or prescribed responses. The first one relates to estimates and specifically addressing bias and making sure that the client was, I almost want to say, unbiased or did not apply the biases to get to material misstatement of the estimates. The second one is with regards to journal entries. We'll look at the detail of that. And then also transactions outside the normal course of business. So in terms of journal entries, we will look at year-end or closing process journal entries. So journal entries that are processed as part of preparing the financial statements. Perhaps other journal entries processed towards the end of the financial year as part of the closeout process. And then the auditor will also consider additional journal entries, whether you have to select additional journal entries. So you don't have to test all of them, but you'll need to consider which additional journal entries might also be relevant and then go and test those to see if they make sense, if they were sufficiently supported. In terms of the transactions outside the normal course of business, already in, I think it was 1050, where we already had a question there to say, have you identified any transactions outside the normal course of business? And then that would have prompted you to record the fraud risk and to then respond to that. All right, so what could be an example of a transaction outside the normal course of business? Well, it could almost be anything. I like to always use the example of buying and selling vehicles when in fact you are a stationary retailer, and then suddenly you are buying a vehicle or something really expensive, maybe even a machine or something, and suddenly selling that and putting that through sales and cost of sales. But it could almost be anything. So an example that I came across recently is even an example of a credit note. Now, in a very specific situation. So it's a client that manufactures very, very specific high-end products for specific clients only on order. So I'm not making, I don't know, baking breads and selling them to every person that comes across my shop, making very specific products, high-end luxury products, millions of rands for each of these products, and I only make them on specific order. The link to that then is there are no returns. Because I make it according to your specifications, if you don't like it or if there's something wrong, then I will rather take it in, fix it, and then give it back to you than taking it back in total and giving you a credit note. In a specific scenario, though, there was just a very, let's call it a very difficult client, and the client really, really, really didn't want to take this back and didn't want to accept the changing of the high-end luxury item. And so just in order to basically save face, to ensure this client didn't go and badmouth us in the industry, we said, fine, you know what, we'll take back this boat, and that's fine. We're gonna issue a credit note, and there you go. There were a few other things that were also strange. So that item wasn't brought back into inventory. It was just then again sold as a second-hand item. Well, it wasn't brand new anymore, so it was sold as a second-hand item. It didn't then get processed as revenue because they were saying they're not in the business of selling second-hand items. So that was put to other income. So you can hear it's just, it sounds very dodgy, eh? So a transaction or transactions outside the normal course of business. And that immediately then sparked a requirement to go and consider what happened here. Is this perhaps fraud? Right. The good news is that was not fraud. It really was just a very legitimate reason for why the client did it. The auditors went to go and investigate everything, and they actually determined that everything was, in fact, above board. There was no dodginess, no fraud, no anything. It was obviously a transaction outside the normal course of business, but nothing unusual and no misstatement in the financial statement. So that's at least the good news story for us. Good. So what are we required to do? So when we've got these overall, well, rather, let me start with when we've got these presumed fraud risks, the standard requires us to have overall responses for these fraud risks. And some of the options we have available is to assign and supervise personnel based on the knowledge, skill, and ability. So you might be assigning more senior staff to performing the field work that addresses some of those points. You might be assigning more. So let's say, for example, you've got a big fraud risk in this client. You might actually say, you know what, I'm actually going to have 2 managers on this job because there's just too much work to review in sufficient detail so that you can actually get to that. Evaluating the selection and application of accounting policies, and specifically looking at subjective measures and the complex transactions, and very carefully considering whether that's treated appropriately. And then also one of the options being incorporating an element of unpredictability in selecting what we're going to do in the field work. So not just saying, oh, well, we're going to sample, nobody knows which ones we're going to test, but also what type of work we're going to do, when are we going to do it? Are we going to do it at interim, at financial year end, or when are we going to do that? I see an interesting point here. I just want to quickly see ACFE. So that's the Association for Fraud Examiners, adopts pressure in place of incentives in the fraud triangle. IRO, that's nice, eh? IRO will help my memory better as it relates to fraud in my language than PRO acronym. Oh, that's fantastic. Thank you for sharing that. Yes, so in the days when I still learned those, we had both words, fraud and, incentive and pressure. So thanks for sharing that. Good. Then another point to consider is resources in our audit. So we're doing this overall risk assessment, and as part of our planning at overall and getting to our audit plan and strategy, I'm saying to you now that we need to consider what resources we have available for the audit. Do we think we have what we need in terms of what we need to do the audit? So my question to you then, and here I'm going to actually ask you to submit responses in the question log. Let me just quickly unfilter everything. Why do you think we should consider if we have enough resources to be used on the audit? Why do you think we should say, do we have enough resources? We're going to consider obviously what is resources, but what are all the things that are included. But even just if we think, do we have what we need to do the audit? Why do we have to consider that? So there's no poll for this one. I want you to please just submit a response in the questions log. Let me know, why do you think we should consider whether we've got what we need? I see one there, so that we have the right resources that will enable us to obtain appropriate audit evidence. Fantastic. And even to that, I want to add sufficient appropriate audit evidence, in order to provide reasonable assurance of risk mitigation so that we can meet the deadlines. Yes, I love that one. To ensure compliance with the auditing standards, the resources will assist us in completing the procedures needed to provide assurance on time, adequate resources to carry out an effective audit, produce a quality audit. Yes, absolutely. Good. Thank you for all of those. I'm going to have a look at them as they come in. So let's just consider then also, I was a bit sneaky, I was asking you that before we were looking at what are all the resources, but I think you guys already have a very good idea of those. So almost want to say in the old days, if I say old days, I mean like within old quality management standard. These days we refer to quality control standards was the old ones. The new ones refer to quality management. Now in the old quality control standard, we just focused on human resources, HR, the people, the staff in the audit team. Do we have enough audit team members? Do they have enough experience? Do they have enough guidance, supervision, and direction from the managers and the partners and all of those things? But now we also go a bit further and we go and we say, can we, with those human beings, get the audit done in time, get a quality audit, all those things that you are submitting there as your responses? But we are also asking ourselves, what technology am I going to use? And do I have appropriate technology? Are the technology that I'm planning on using approved by the firm? Or am I just using any kind of cool software that I've come across on whatever social media site that I saw and thinking, oh, this is cool, this is going to save me so much time, let me do that. So for example, if I use my phone, now I'm going to start a little sermon here, bear with me. If I use my phone to scan documents so that I can put them on my working paper file, is the software that I use to scan those documents approved by the firm? Because I'm going to be scanning client documents, and I need to make sure that those client documents are not uploaded to some site as part of my free app that I'm using, and therefore I'm actually not complying with the with the ethical requirements of protecting the client's confidential information. So is the technology that I'm going to use appropriate? Is it approved by the firm? Of course. Are we using the right version of the software, the right template? Are the up-to-date stuff? Currently, if you're auditing any audits that work with December year ends, if it's a group, you have to comply with the revised ISO 600. Does your audit template have the revised ISO 600 in there, or are you still using the old ones? I came across a client the other day who are still using the old Probe working papers, or some other working papers that actually have their own methodology, and they haven't adopted ISO 315 revised 2019, which has been effective for probably about 3 years already. So is your technological resources up to date, and are you using the right technological resources? With that, intellectual resources, so perhaps your template working papers, your examples, your standard working paper templates, those things, are they up to date? Are they appropriate? Or are you using your own little working paper that works for you, but maybe that's not approved? Maybe the firm said, no, when you're doing X working paper, you must have these elements in your working paper. And with that, we can also go to service providers, because in service providers, if we're going to use service providers, other persons to help us in the audit, for example, performing stock counts at other clients. Maybe another really good example is even using persons to perform engagement quality reviews for us. If those people do not know what to do and how to do it, or if they don't know what we expect of them, or they're not sufficiently experienced, they can actually let us down. I see someone here that says the resources have a significant impact on the credibility of our audit work, and on the credibility of our audit opinion. Absolutely. So that is absolutely important, and we need to therefore consider it. We've probably always considered it, but there's now just a more explicit requirement for us to just consider it in sufficient detail, and with that, to document that we've considered that. Then, communicating with the team. Now, as a team, we need to communicate, right? Yes. So my question to you is, how do you, in your teams, communicate the required procedures, the materiality, things to watch out for, information that you've come across in your planning of the audit? How do you communicate that with the rest of the team? So I'm going to launch another poll to say, please indicate to me, do you say everybody has to read their audit programs to know what needs to happen? Do you have a planning meeting where you share this kind of information? Or do you just say, no, we don't communicate, everybody should already know what to do? Or maybe you've got another option. If you've got another response, you can select other, and then please let me know in the questions blocks again, what is that other? How do you do that? I guess it's kind of not really a surprise. There are a few that says, now everybody that just needs to read their audit programs. We don't communicate. Everybody should just know what to do. Hopefully, when it is some of the more bigger audits, or audits where there are less experienced team members, we do have a planning meeting. Yes, the standard requires us to actually have a communication, and so to some degree also a planning meeting, but it says that the engagement partner must have a meeting. So it doesn't say everybody must be in the meeting. The ideal is obviously to have a planning meeting, as 91% of you all voted. So thank you for your input in that regard. Now let's go and see what the standard requires. The standard requires the audit team to have a communication with each other about the risks identified as part of planning, to communicate the materiality with each other. Now, agreed, everybody can go read what the materiality is in the file, so that's maybe not the most important point, but we can also say that we need to actually communicate materiality of specific materiality matters. Fraud risks. Remember, I might have said this in the past also, I don't know, but with things like related parties, for example, we need to all be aware of who the related parties are, where the possible fraud risks are, things to look out for. And then with that also, basically a communication to say, if you come across any fraud risks, any things that might affect our audit risks, things like even saying, possible no-claw, anything that needs to go to the partner that we need to communicate specifically to the partner and ask him or her to actually go and address for the client. Those things need to be reported here or there or whatever the case may be. The expected behavior of the team on the audit, and that includes, of course, our ethical behavior. So those kind of things are really important for us to communicate with the team. Standard says the partner must meet with the team, and if not everybody is there, then we need to make sure that everybody else gets the communication in some or other form. So that doesn't have to all be in the same planning meeting. You can also, for example, have a memo of what was discussed, etc., shared. I've got a response here from someone that says, at the firm, we create a special channel on Teams or Discord to upload and keep everyone up to date in real time. That's fantastic. Thank you very much for your response. Yes, that's almost like using the newer version of a little memorandum or a file or something somewhere, but actually having that electronic communication available for everyone. So that's fantastic. Thank you. Right, so that brings us to the end of the theory. Now, before we go in our breakaway sessions, I just want to remind you that we still have 2 more sessions after today's session, and I'll probably, if I remember, also end with a slide in the probe session. But please just remember that in the next sessions 4 and 5, we are going to go, after we've done the overall risk assessment for today, we will then go and do the assertion level or account balance level risk assessment for specific accounts, specific risks, and show you the process that you walk again through section 10, 11, and so forth in your planning section, your risk assessment sections. So the sessions there, you can see the dates there, 28th of March and the 4th of April. Please be sure to also join us for those sessions so that we can have as much participation, and also so that you can see how these things work in the files. Right, but that's in the theory for today. I'm now going to then show the slide for the breakout time, and then we are going to go join for the probe guys. Let me move over to the next slide. The Audit International delegates are going to stay in this webinar as you have in the past. The Probe Audit delegates will move over to the breakout link that you've received.